Hello and welcome everybody. I'm Vern Cushenberry, Chief Investment Officer and founder here at GoalPath Solutions. And today I want to share with you a little bit about how we select mutual funds and monitor those funds and report on those funds on behalf of our clients. We assume what's called a 338 fiduciary liability for that process. And we take it very seriously. And one of the more common questions that I get on behalf of our investment committee as the chair of that committee is how do you do what you do? So I want to share a little bit of that with you today, but before I can get into the actual operations of how we assess funds and go through a quantitative process, I want to share with you a little bit about our investment philosophy, because generally we are underneath the regulatory body of ERISA legislation, the Employee Regulatory Securities Act. So we have to have a prudent process, and we have to have good justification for what we do. So we take a very careful study of the markets. ERISA and the body of trust law that underpins ERISA describes that fiduciary process as prudence, and the governing body of legislation is the prudent man rule, which requires us to be experts at what we do. And in order to be experts, we have to know and have carefully studied the markets over the last several hundred years. And this slide shows everything that goes on in the markets on a daily basis. What happens in the equity markets, what happens in the fixed income markets, what happens to balanced portfolios and economic expansions and recessions and different political administrations, and how does that fit in globally with our trading partners, and what's it mean for interest rates and inflation and housing prices and so on and so forth, and how does that affect different industries. And it's a massive amount of information and data that we have to take in on our clients' behalf and assimilate into a process that we can use to make informed decisions. So I share this chart, but then I always try to be very purposeful about segueing into this next chart, which we call removing the noise. And one of our jobs when we're trying to create real and positive outcomes on behalf of all our constituents is to be able to know the difference between what's meaningful information and what's just noise. And when we strip out a lot of that noise, what we're clearly left with is the impression that on average over the long run, and these are retirement accounts, remember, so the long run is what most of our clients have. Even if you're 65, you have a 20-year life expectancy, which makes it appropriate to have a good portion of your retirement account in the stock markets. And over that long run, markets generally move up and to the right. We have the benefit of participating in those gains over the long run. So this next chart casts a different light on the same data and shows investors that when they do focus on the long run, they can generally expect a positive return. And let me go through this chart in some detail here, because I have found that with our retirement plan participants especially, if they can get a handle on what this data shows in this chart, it creates a real sense of peace, especially during times of volatility. So this chart shows equity markets, bond markets, and a mixed portfolio over 1, 5, 10, and 20-year time periods. And you can clearly see that over any one-year period dating back to 1950, the equity markets vary from down 39% on the low end to up 47% on the high end. And that is a lot of volatility. Anybody that gets an account statement in the mail that says down 39 is going to be worrying about the future of their retirement. This is not where your focus should be as a long-term investor. Your focus should be on the 5, 10, and maybe even 20-year periods. Let's just look at the 10. If you focus on a 10-year period, the equity markets in any 10-year period dating back to 1950 have fluctuated between down 1% on the low end, that's the lowest return, to 19% annualized on the high end. That's a much more palatable number. And if you pan out to a 20-year time horizon, the equity markets have never lost money. As a matter of fact, the lowest return is 6%. And that's what we really need to be focused on, because it's the knee-jerk reactions that have a tendency to get investors off track. And you see that here in this next chart. This is what we're trying to defend against. Our job as investment advisors is to prioritize the areas where we can have an impact and rightly order those on behalf of our clients. And what we see is that we need to make sure that we benefit from the nature of the markets to move up and compound over time. Generally, when we look at the returns to the average investor here, what we notice is that, 2.5%, that's quite a bit lower than the return to the S&P 500. And this data holds true over this time period, but any 20-year time period you're going to look at, you're going to see similar numbers. There's always a wide gap between a buy and hold approach, even if it's a blended portfolio, vis-a-vis what the average investor is able to generate left to their own devices. Now, why is that? Why is this so hard? It's so hard because we're all subject to mental errors. We have a tendency to get excited when the market's excited, when we see the market going up, and that creates a buy high strategy. And then we have a tendency to get nervous when we see the market reacting with volatility to a piece of news. COVID is a prime example of this. The market sold off by nearly 30%. And our blood pressure starts to go up as humans. It's written into our DNA. This is our natural response, and we have to fight against that if we're going to be able to capture the long-term returns available to investors. And we're just not conditioned for that as investors. And this slide puts that human nature in and put some color on that. You can see here, if you're fully invested, again, over this time period was 95 through 2000, a fully invested investor generated nearly 9% rate of return over that time period. Now look what happens if you get scared, sell, go to cash, and you miss one of those reflexive knee-jerk responses to the upside that the market is so prone to. And that's exactly, again, COVID's a great example. The market rebounded very, very quickly once we mounted a regulatory response and injected nearly $4 trillion into the economy. You can see if you miss even the 10 best days, you've already cut your return in half. Missed the 20 best days, missed the 30 best days, and now you've already cut your return down to nearly zero. So if we take action, we have a tendency to harm ourselves. And that is not only individual investors. So our job as consultants is to take a careful study of the market. And as a part of that, we want to be able to observe, well, what does work? We must be able to guide our decision-making, ground our decision-making in something that's worked in the past. And if individual investors aren't generating those returns, then we want to take a careful study of professional investors. I mean, we want to take a careful study of academics. We want to take a careful study of consultants. Where and who has done this well over time? And what are those strategies? And then let's test those strategies to see if we can replicate them. That's how we're going to inform our decision making. We're going to be able to point back at something that has worked in the past so that we can put the fiduciaries and the plan sponsors of the retirement plans that we do business with in a defensible position. Because at some point in the future, you may be called upon to defend the decisions that you're making on behalf of plan participants. And if so, we want to make sure that that's grounded in real evidence that we can point to that has worked in the past. So we look at the track records of professional investors, and they're pretty dismal. I call this study one of the most convicting studies in our industry. It's published by Standard & Poor's, and they put this out semi-annually, I think. It's a US scorecard. They call it the SPIVA index. And they look at all mutual funds, domestic and global, fixed income, equity. And what they observe is that over this particular 20-year period, and this has held for decades, 94% of large cap managers, 88% of mid cap managers, and 88% of small cap managers failed or trailed their respective benchmarks. Now remember, the benchmark is an investable product. We as investors have the option just to say, well, rather than pay somebody to select stocks that are going to do well, just buy all the stocks. That's a very naive strategy, but it's easy to execute and it's cheap. And over time, given the way returns compound and the nature of the way these indices are built, that is a very, very successful strategy. So these managers are failing by and large, by a wide margin, to earn the fee that we pay them to beat these benchmarks. That's concerning. What's that mean for the way we select mutual funds as a 338 on behalf of our clients? Well, it means we're still looking for a replicable strategy. It means we're still looking for that North Star or that guiding lamppost, so to speak. So if the professionals aren't generating value that we can look to and say, aha, that's how we select what works in the field of investing. Let's look at academics. This is a study that's a couple years old now, but put out by Vanguard, and I've seen corroborating data, every year as reported by Nakubo. But it took a look at the world's endowments. So these are the academics. These are the people who teach. Now, I teach. I feel like I know that world. I'm an adjunct professor at the University of Missouri here in Kansas City. And endowments, by and large, have no better track record. If you look at the performance of endowments over the last 5 years, you can see, small endowments defined by those with portfolio sizes of $100 million or less. So not particularly small, but small in that world. They performed best over the last 5 years, but still failed to beat a naive 60-40 benchmark. And you can see larger endowments, they've done a little bit better. These are the Harvards and Yales of the world. They have access to some private equity investments that have driven returns over those time periods that other smaller size portfolios do not have. But if you just look at the smalls, especially, and for the most part mid-size, they've failed to beat their benchmark in every time period, which doesn't give me much confidence that looking at the world of academia, we're going to find a replicable model. So moving on, what about the worlds of consultants? When you get into consulting on multi-billion-dollar pools of private wealth and sovereign wealth funds and pension funds, these are the Aons and Mercers and those types of companies. Well, we looked to a study that the Journal of Finance did, and these were a few professors took a look at the recommendations of the largest consultants in the world, and they found, to shortcut this, they found no evidence that these recommendations add value, suggesting the search for winners encouraged and guided by investment consultants is fruitless. So all of a sudden, our job's getting more and more difficult. On average, individual investors fail. On average, professional investors fail. On average, academics fail. On average, the largest consultants in the world fail. So where are we going to go to inform our decision making? We're still looking. Well, one of the places that we can go, one of the levers that we can pull that we know with certainty is how much of a benefit we're going to get every time we pull that lever is with costs. If we keep our costs low, we know with mathematical certainty what we're going to save on an annual basis over a fund that's more expensive. So let's start there. We know costs. And that's corroborated by this study that was published by Morningstar a few years back, where they took a look at the costs. I love this study too, and kudos to Morningstar for even publishing it, because I know the temptation was probably just to bury it in some back room in their Chicago offices, but they didn't do that. And I have a lot of respect for that. They're trying to get better at what they do, and I hold Morningstar in very high esteem. And this study shows us the power of costs. So let me just look at the blue bars here, and I'll go slowly because this is very important. It's very important for how we select investments on behalf of our clients too. So here we are. Let me get my cursor there again. Here we are in the blue. Morningstar took the USS equity category and they divided it into 5 quintiles, and they rank ordered those from least expensive to most expensive. And then they measured the percentage of those funds that went on to subsequently outperform their peer group. So 62% of the funds in the cheapest quintile went on to outperform their peer group. That's a pretty good track record. Only 48% of the funds in the second cheapest quintile went on to outperform. And you can see the way that relationship unfolds. Cheap wins, expensive loses. And that holds across US equity, across sector equity, across international equity, across balanced portfolios, across taxable bond portfolios, across muni bond portfolios. So I feel like I'm belaboring the point a little bit here, but all of the data that we've been able to gather points to the notion that fees have to be your number one concern. Does that mean that the pursuit of excess return is fruitless? Not necessarily. I've spent the last 20 years of my career trying to find out what works in investments, but I have come to one solid conclusion, which is fees have to be one of the most critical components of selecting investments inside of your plan. So how do we structure that inside of GoalPath? How do we structure that inside of what we do? Well, the way we've built our system is on academia. It's all based on being able to put ourselves and the plan fiduciaries that we work with in a defensible position. So we don't really have an investment committee. We do, but we call it something else. We call it an academic review committee because we're not making decisions based on our own internal proprietary process. We're reviewing academic literature that's published around the globe, tens of thousands of academics, discerning real, measurable, quantitative research that we can point to and say, this is statistically significant. This is a strategy that has been proven to work across time. This is a strategy that's robust. This is a strategy that has been peer reviewed. This is a strategy that has been published in a real academic journal. If we can tick off those 5 or 6 different check marks, well, then now we have something that makes us feel really good as a fiduciary that we're building a defensible solution. So we call it standing on the shoulders of industry giants. And these are the most established and widely acclaimed professors that have really put in place the body of what we now refer to as modern portfolio theory. We supplement that with the new and emerging body of research from 70,000 academics around the world. And then it really just becomes our job as a fiduciary to oversee that on a periodic basis. Again, we're really leveraging the power of our academic friends to make sure that we have a robust and defensible process. As we put that through our little machine, you can see that creates a lineup selection on behalf of our clients of low cost, widely diversified, index-based solutions, enhanced index-based solutions that are supported by this body of academic literature, and then more concentrated active positions that are the riskiest solutions, but also similarly supported. So let me move on and I'll get into a little bit more detail on how we execute that. This is another graphic that shows how we support that investment philosophy, which we call reaching for return. And we've tried to cast that out for our clients on this with this graphic here. Reaching for return starts with an index-based approach. If you're of the mindset that you're comfortable with the notion that the data says, well, you'll probably be in the top quartile if you just broadly diversify and keep your fees low and go with an index-based approach, well, that's a pretty good place to be. So we start there. And then if you're of the mindset that you should be able to do a little bit better in the world of investing. You don't want to pair your capital with simply an index-based approach, but there ought to be a better way to invest. Well, then we have an enhanced index-based approach. And you can see as we move from left to right, your risk level is going to increase, your fees are going to increase, the strength of evidence, and I'll take you back to your Stats 101 class. You measure the strength of a data set when you test that with something called a T-stat. Well, the stronger the evidence is, the more confidence we have in that solution. So as we move from left to right, as we reach for greater and greater return, the strength of your evidence goes down. The opportunity that you have goes up. The opportunity for return goes up. You're reaching for return, but you're taking on more risk. And your success rate also goes down, as supported by the numbers that I just reviewed at the top of this little presentation. So we take all that and we push it through our process, and you can see that we start with an initial universe of 20,000 funds. We have a quantitative assessment, which is a quantitative process to make sure that any of the funds that ultimately end up in our evidence-based lineup are adhering to those academic solutions. We look at fees and diversification by holding, and we call these table stakes. This is everything that our industry expects us to be looking at. And our quantitative process allows us to do that on behalf of over 20,000 funds. And then finally, we have a qualitative review where we may have conversations with the management team. We'll look at other more subjective measures associated with the firm and investment philosophy. We'll make sure there aren't any legal or outstanding issues that are going to affect the fund or the execution of those strategies on behalf of our clients. And then that process allows us to fill a fund lineup on behalf of our clients. Looking at that in a little bit more detail here, this is what a typical fund lineup might look like. There's actually more choice here than what we might typically recommend, acknowledging that choice and outcomes are typically inversely related. Participants have a tendency to get overwhelmed when you put too many mutual funds inside of their lineup. But we want to make sure that this style box approach to investing satisfies 404C, so offers certain fiduciary protections to our plans, gives enough choice, but balances too much. And then let's see some more detail on the data that we look at when we monitor a fund. We meet as an academic review committee on a weekly basis to monitor all the funds. We monitor turnover at the portfolio management level. We monitor turnover at the staff level. We look at risk return analysis. We do due diligence reviews on a quarterly basis. We look at peer group analysis. We will publish a kind of an overview of what's going on in the economy on a quarterly basis, and then all the factors that may or may not put a fund on a watch list. I will note that we give a heavier weighting to the longer term time period, a 10-year time period. Generally speaking, what we're looking for there is both a bull and a bear market. It's our job as your consultant to be able to recognize luck from skill. And in order to do that, we need a sufficient time period. And that sufficient time period really needs to encompass both a bull and a bear market and an economic expansion and an economic recession. And that time period is usually 7 to 10 years and can go longer. So that's a little bit subjective. We just want to make sure that we have sufficient time to differentiate luck from skill. And then lastly, I want to give you just a few examples of some of those more meaningful data points that have withstood the test of time, that have withstood the test of academic rigor. And they showed up on the last slide here. Some of those there's a size premium in the investment industry that has withstood the test of time. Smaller cap stocks tend to outperform larger cap stocks over time. So everybody wants to buy Facebook in 2006 or Microsoft in 1982 or Berkshire Hathaway in 1965. Well, if I give you a list of small cap stocks, good luck picking out the next Amazon or the next Apple before the fact. But what we've observed is that if we buy a basket of small cap stocks, those return premiums show up. So we can ever so slightly tilt our portfolio towards size. The same thing holds true for quality as measured by return on investment capital, as measured by strength of balance sheet data and some other indicators, and value. So we look at that academic research that supports some of these, and we measure the strength of that evidence with our quantitative process. And there's some more detail on this slide here about what we monitor. You can see how we weight some of these factors in our process. And I don't share the exact weightings because, as I mentioned, this is subject to the economic environment. So these weightings are subject to change. They're not static. We have to have a dynamic process, but I can give you some information on which is more important and which is less important. And certainly, as I mentioned just a moment ago, cost is a huge factor in how we look at mutual funds. But we weight the longer term time periods more heavily. So 10-year, that's given a high weighting, 7-year medium, and then anything less than 5, which is almost guaranteed to be less than a full market cycle. We monitor that, we pay attention to it, but it has less of an importance. So if a fund didn't do well during the last quarter, yeah, absolutely, we're going to monitor that. We're going to ask questions. We're going to make sure that there's nothing going on internally that we need to be aware of. But generally speaking, that's not going to carry nearly the level of importance as the long-term track record. Similarly, we're going to weight what we call table stakes. These are factors that we monitor, but they have a low weighting in our process. And table stakes, absolute return, relative return, excess return, risk-adjusted return, everything that we need to be monitoring from a modern portfolio theory, but they have a low weighting in our process because at the bottom of every statement you've ever looked at, you see a little disclaimer that says past performance is not indicative of future results. And that bears out academically. If you screen for every fund that's done well in the past, they have no better opportunity of doing well in the future than just a random draw. And they call these persistent studies, and different persistent studies bear this out over time. So we monitor all of these, but they have a low weighting in our process. Fiduciary factors get a slightly higher weighting. This would be R-squared, tracking error, expense ratio. We're hiring these managers to do a job inside of our 401k lineups, inside of our 403b lineups. So we want to make sure with an R-squared measure and a tracking error measure that they're sticking to their style box, so to speak. We want to make sure that they're actually investing in the types of securities that we're hiring these managers to invest in. That has more of a fiduciary component to it, and that gets a slightly higher weighting. The factors that we weight most highly are the ones that have withstood the academic testing. So expense ratio, #1 in our process. The value factor has a very strong T-stat historically, same way with quality, same way with size, momentum to a certain degree. We watch all those and we're always evaluating for new factors. All of this goes into an overall qualitative assessment and helps us select mutual funds on behalf of our clients. Now, in this deck, which is available to you, I give a little bit more information on what drives the size premium and the academic research that substantiates that. Same way with quality, same way with value, same way with momentum. Wanted to give a little bit more information to our constituencies. So please feel free to reach out to me. I know that this topic in particular is one of the more technical in nature, but it's important. It's important that our clients have an understanding of what we do, and our clients have an understanding that we really are trying to think on their behalf, and we really are trying to put them in the most defensible position that we possibly can. And we've created a framework to accommodate that at different risk thresholds. So reach out to me with any questions that you might have, and I welcome taking a deeper dive at any time. Thanks again.